All right, we will call to order the August 12th meeting for the Oklahoma City Public Employee Benefits Trust. We have a quorum by the skin of our teeth. And the first item that we have is to approve the minutes from the June 10th, 2013 meeting. You guys can take turns first, motioning and seconding.
Second on this one because
Second?
I was not at the meeting.
I'll second it.
Okay.
All in favor? Aye. Very good. The next is to receive the monthly investment flash report for June 30th and for June 31st of 2013, and Doug is here to present those.
Good morning, Mr. Chairman and trustees. If I could ask you, since we're going to cover the quarterly report June 30 as the next agenda item, I think that in the best interest of time, just look at the preliminary July 31st report, which is in your packet. As we look for the market environment first, you can see during the month of July, it was an extraordinary, not extraordinary, but it was a very good month for equity performance. As you see, July 13 market performance update, the S&P 500 was up 5%, which was a good rally from the difficult period just the month before. Small caps were up 6.8%. REITs, however, real estate investment trusts, trailed by a significant margin because of the rising interest rate, or the potential for rising interest rates in the United States economy. As we go down further, you can see that mid-cap growth was up 6.2, small-cap growth, the Russell 2000 growth was the best performer during the month, up 7.6%, and international equities were roughly in line with U.S. If we look over the last year, you can see some remarkable returns, but also some dispersion within those, especially when you compare domestic equity versus international equity. Both of them were good. The nice thing is that we did not have a distinct exposure to the bottom performer, which is emerging markets, which was up only 2%, compared to the domestic equity market up 25%. And that's an extreme change from just 2 years ago when China and India seemed to be the only place growing in the world. The risk-off trade has come away from emerging markets, predominantly because of this potential for increased interest rates in the U.S. and slowing European economy. Most of those economies are energy or materials or minerals-based, and with the ongoing threat of slow growth in the developed markets, a lot of investment has come out of those areas. We think it was too hot. Too much money was pouring in 3 years ago, 4 years ago, even 2 years ago, and you can see what happens when investors get very nervous or they get very greedy about a single asset class like emerging markets. As we go over to the fixed income table, the bond to total returns, you can see that it has been very difficult. This will be one of the first times, I believe it may be the first time, that we're coming in to show you negative results in the bond market. So if we look at both of these, we had bonds were down during the month of July. They were down during the second quarter, while equities remained positive for the month and very positive for the year. So it's almost an absolute change, almost complete opposite of what we have enjoyed during some periods of our tenure together, where fixed income, great performance, equities not so great. But again, this is a shocking, shocking thing to see for the first time. Now, are rising interest rates good? Some investors, they are good. If you're discounting a large liability and you're using interest rates to do that, market set interest rates, higher interest rates mean that your liability will be discounted at a higher rate, thereby shrinking it. Now, when we see higher interest rates shrinking a liability, and we see asset prices going higher on the equity side, that is the really quite good for long-term investors with fixed liabilities. Let me rephrase that, not fixed liabilities, but large outstanding liabilities. As we go to the following page, performance has been mixed. It has been positive on the equity side. It has been fairly good on a relative basis on the fixed income side. So as we go across this table, the most important thing to notice is as of July 31, the trust had almost $23 million in it, which is a substantial increase from when we were retained. 30%, almost 30% of those assets are invested in JP Morgan core bond, which is the core fixed income portfolio, meaning that it invests in treasuries, mortgage-backed securities, and corporate bonds. Direct appreciation is the large cap core equity portfolio. It's almost 36% of assets. Its performance has been positive, but it has been lagging the benchmark because it's investing in extremely large companies, multinational organizations that are based primarily in the United States, growing companies with extraordinarily strong balance sheets. In this environment where risk has gone on, traders have been seeking out high-risk securities. Their portfolio has not performed as well over the trailing 1 year. You look over long periods of time, and what most impresses us about this fund is their risk-adjusted results. They are much less volatile than the S&P 500. They provide solid dividend income, and it's a nice place to start the domestic equity portfolio. As we go down to the next portfolio, it's Delafield, which is a mid-cap value equity portfolio that is extremely distinct from the market. It doesn't look like the market most of the time, and its performance is quite different from the market. If we look at the numbers on June, it didn't look quite as good as it does right now. But over the last 1 month and the last 3 months, you can see top quartile results. As we look out very long term, over 10 years and 15 years, you can see it's outperforming the benchmark and ranking in the top decile of its peer universe. The Stevens Small Cap Growth is a very growthy, very small cap portfolio, meaning that these are emerging companies that have been founded fairly recently, or they're core growers that just haven't made the leap to mid caps. And you can see that the returns here over the last year, up 30%, trailing the benchmark somewhat because they're investing in some of the more stable growing companies in their area. But you can see over the last month, 7.2% is a significant return for a 1 month period of time for a portfolio. 14% over the last 3 months, 30% return over the last year. And as we look at the 5-year results, we can notice that those are starting to improve pretty dramatically as well. While we don't have a 5-year return for the trust, that you can see that it is really dramatically increasing. So as we look over the last year, the total fund as of July 31st was at 13.1%. That did underperform, and most of that underperformance was from our very large cap portfolio. Again, they're long-term investors. They invest in very stable companies. And the reason that we put that fund in place was it allowed us to take more risk with the Delafield and with the Stevens small cap portfolios. We feel that if you have a very strong foundation, then you can really reach for additional return with the smaller portfolios, which in total are 12% each versus a 36% allocation to the large cap. The last one is the Thornburg International Value, which has been keeping pace with its benchmark. Over the last 1 year, some of that emerging markets allocation that they had did drag their results down. Over the last 3 years, they're trailing the benchmark. As we go out over longer periods of time, the returns do improve. But taking a look at this fund, performance over the last 1 month and the last 3 months has started to come around somewhat. The index was down for the quarter. This fund was actually up slightly, leading to a 13.1% return for the total fund for the year. Happy to take any questions.
All right, are there any questions? All right, thank you, Doug.
Thank you.
So I'd receive a motion to approve both items, both reports.
So moved.
All in favor? Aye. Next item that we have, you want to go ahead and go through the quarterly report?
Yes.
Okay.
Prepared to.
Yeah, go ahead. I'm sorry.
Thank you. You will see the second quarter 2013 report. As we open to page 2, market environment, the tale of the taper, as everyone is probably very familiar, the chairman of the Federal Reserve, probably the most influential person when it comes to markets and economics in the world, mentioned this concept of tapering the monetary policy that's going on right now. And what he was talking about was the Federal Reserve now buys approximately $85 billion of bonds in the open market every month in an attempt to hold down interest rates. And he said that the economy is starting to grow and show signs of growing, and unemployment is coming down somewhat, and it might be time to start tapering off that program. That spooked the markets because since 2008, 2009, the Federal Reserve has said nothing anything like what he said on that. From that time, it has been, we will throw as much money at the problem, at the economy, as we need to get inflation lower. And this is the first time that anyone on the Federal Reserve Board, much less the chairman, said that we may be nearing the end of monetary stimulus policies. So that threw markets for a loop. Interest rates went up, equity prices went down, and it was not a very great way to end the second quarter of this year. You'll look on the first page there, you can see on the upper right-hand side real GDP growth. You can see that we're kind of stumbling around at very low levels. These are year-over-year figures. The rates as they have been published have been revised, always upwards, it seems. And if you look at the table at the bottom, we show the quarterly real GDP on an annualized basis, going back to 2011. As you trace those numbers across, you can see that there was some strengthening in 2011, where we had the second, third, and fourth quarter, 2.5, 1.3, and the fourth quarter extremely strong at 4.1. But then as we go through 2012, it's a little choppier, and as we go through the fourth quarter of last year, 0.1, and then just 1.1% for the first quarter of this year. So growth is still disappointing. Unemployment, as you see on that second level, it's 7.7%. The tapering is supposed to start when unemployment gets down to 7.5%. But that's just the number of people who are working. The unemployment rate, we think, is understating the underemployment within the United States. When you're seeing massive amounts of people actually falling off of the employment rolls because they're no longer seeking work, we're at an all-time high, and not just by a little bit, but by an enormous margin of people on disability, and those are not counted in the employable folks numbers. And then we're also seeing there's a trend very strong this year of part-time employment. I think there have been 900,000 jobs created this year in the economy, and 750,000 of those have been part-time employment. And a lot of that is to get under the 40 hours or the 30-hour full-time employment requirements by the Affordable Care Act. So you're seeing a lot of people losing their full-time job and picking up one or hopefully two part-time jobs. Unfortunately, no benefits associated with them. As we go down to the following page, you can see on page 3, this is equities, domestic equities, where performance was in the market on a second quarter basis and also on a year-to-date basis. Important areas you can see on this: financials up 7% for the quarter, 20% for the year-to-date. Healthcare 4% for the quarter, 20% for the year-to-date. As we look to energy, something that has done well in the last few years, down slightly for the quarter, up 10%. What I want you to really take away from this chart is that the performance was widely variable during the quarter, and it was also widely varied for the year, where we're anywhere up from 3% for materials, that's raw materials, all the way up to, you see 3 that were up 20%, consumer discretionary, healthcare, and financials. So performance was widely scattered during the quarter. As we go to international equities, one thing that we would like to say here is that we're early in international equities. Performance has been poor, especially in U.S. dollar terms, but we think that it's extremely cheap. We don't think that, despite the recent underperformance of international equity, that we should be abandoning it. If anything, we're encouraged that some more nervous investors are getting out of it, creating more value for long-term folks with long-term investment horizons. As we go to page 5 on fixed income, we're almost finished with the market environment here. Second quarter 2013 sector returns is the table on the bottom. Something we've not seen is all sectors of the fixed income market were lower during the quarter. You can see anywhere TIPS or Treasury inflation protected securities down 7.1%. Long credit, those are corporate bonds of long duration, down 5.8%. Emerging markets down 4.7%. And the aggregate bond index itself was down 2.3%, which in fixed incomes is pretty serious loss. You can see the index comparison on the following page for the quarter, the 1-year, the 3-year, and the 5-year. 5-year return is improving. For equities, it's fairly stable on the fixed income world, where you see that high yield is, oddly enough, performing very well. Even in this difficult bond market, higher risk bonds that pay higher yields outperformed during the quarter, and also very much for the 1, 3, and 5 years. International equities, compare the results of international equities for, say, for instance, the MSCI EAFE, negative 1%, versus the S&P 500, which was up almost 3% on the quarter. And as we see go down to the emerging markets, those were down 9%. China, which it's almost an analog for the MSCI Pacific ex-Japan, was down 10.9% as the world is getting used to a slowing economy within China, which appears to be a reality. Start going through the portfolio. The page numbers shift to the upper left-hand side of the pages here. And you can see that during the quarter, domestic equities were positive. International equities were down as international equity markets were down. Fixed income was down. And unfortunately, the trust was off slightly. Over the last year, you can see as of June 30, domestic equities were up almost 15%. International equity up 13%. Fixed income up modestly. And the entire trust was up 9.6%. And over the last 3 years, a similar pattern of returns, fixed income lower, international equity lower, but the total fund was up 8.3% annualized over the last few years, which is above the goal rate of return for the trust itself. Remember, we're not necessarily investing exactly how the market invests. We're investing how we feel is most appropriate as a group for this trust, which means our equities tend to be lower risk than the market. The fixed income portfolio pays a good yield, and the pieces of the equity portfolio fit together. They mesh together very, very nicely. Now, unfortunately, that means that we have a saying, it's a rule of thumb, if you're not underperforming somewhere, you're not properly diversified. We can see the history of returns on page 8, the sequential quarters. The last 2 quarters, or as we go across, we have some losses here, but we have to go back to a year ago since we've seen losses in the portfolio. Summer times over the last 3 years have been quite difficult. We're not exactly sure why that is, but as we get through the first quarter, returns tend to be good. Second quarter and third quarter tend to be a little bit more difficult. The annual return history is shown on page 9. Year-to-date returns so far for 2013, the policy index is up 7.86. Unfortunately, the portfolio is underperforming that because of the more defensive bias of some of the equity holdings. Discussion items. We are familiar with all of these. Remember, early during 2012, we replaced the American Funds Growth Fund with the new equity lineup. Dreyfus Appreciation, Delafield, and Stevens Small Cap Growth. They fit together very nicely, and it allows us, if there's underperformance in one, to replace that we deem serious enough. We really like page 11. Page 11 looks great. The growth of the fund over time started out at about $6 million, and it's grown to $22 million. Most of that has been due to contributions. We have helped a little bit along that. And we think that in the future, it's mostly going to be from contributions, but we're providing a safe level of returns with a very low level of risk going forward. Page 12 is the portfolio the portfolio review. You can see that the only top quartile result that we show on actual results was for the last 3 months. The J.P. Morgan Core Bond Fund actually beat the benchmark, and it was in the 19th percentile. PIMCO, BlackRock, Double Line, some of the biggest portfolios, fixed income portfolios, had absolutely horrible quarters. During the second quarter, down almost 3 or even in some cases 3.5% for the quarter. We'll see that Dreyfus Appreciation has still not, this is as of June 30, is exhibiting a similar pattern. We saw very nice improvement out of Delafield and Stevens, and we're still waiting for that improvement out of Thornburg as well. But again, patience will pay is our philosophy. As we look on page 13, you can see how the market value has grown. We list the large cash flows to the trust over that time. And you can see the allocation on the left-hand side. On page 14, the allocation by asset class, and a risk-return scatter chart on the right-hand side. Stevens is where they should be. J.P. Morgan is where they should be. As we go from left to right, we're going from lower risk to higher risk, and as we go from bottom to top, we are going from lower return to higher returns. This is very common right now to see your international equity portfolio in the wrong place. Performance has been poor for international equities. They've not enjoyed the rally domestic equities have, and so most portfolios that we look, the international equity is to the wrong side of where they should be. The target versus actual allocation is very close. No moves are necessary there. As we look on page 16, the domestic equity portfolio statistics, you'll see where the allocation is amongst the three managers. And you can see that the mean annual return over the last 5 years in the current structure would have actually beaten the benchmark, and that's what we're looking for. All these figures are net of fees. As we go to the risk return history on page 18, this is an interesting chart where we show the managers in risk return space as we have before, but we also show the relative size of their portfolios. So you can see that the largest part of our portfolio is dead in the middle, and that's where we want it to be. That is the building block for the rest of the equity portfolios. JP Morgan bond, lower returns, very low standard deviation. Again, that's where it should be. Delafield, over this 3-year period, you can see that they're below where we want them to be, but Stevens and Delafield may switch places over the next few quarters. And then Thornburg, as I said before. Status summary is on the following page. We would be comfortable, given the performance from Dreyfus Appreciation, of putting them on alert. We do not think that it's time to terminate them, but given the performance versus their relative universe and versus their benchmarks, I think that would be an adequate decision to make right now, being that this is a public fund. We counsel patience on that portfolio. We've seen this pattern many times in the past where they underperform for short periods of time, but then they outperform very abruptly. Page 20 is the correlation. Remember, correlations are very important. They tell us how our assets perform versus one another. And remember, we were very cognizant of this and trying to build low correlations amongst our equity portfolios. Take a look at Dreyfus Appreciation. 0.86 is low for the Stevens small cap growth, and Delafield at 0.85 is very low. Our fixed income assets have low correlations, if not negative. And our international portfolio also has low correlations across the board. It's very important on page 21 to pay attention to what fees we are paying for these. All of the returns we show are net of management fees because they're deducted on a daily basis. If we go down the list, we show the expense ratio for the funds versus their category average, and then we show the difference. As we go down this list, you can see the numbers are all green, which means that we are paying less in the category average, and it's by greater than 1/3 off versus their peers. That is also a result of thoughtful work on this. Lower fees give you a head start versus your peers over market cycles. That concludes my report for today. Happy to take any questions.
Good question.
Yeah.
Yes.
Back on page 19, you said that, I think I heard you say, that you're recommending that we place Dreyfus Appreciation on notice?
On alert.
On alert.
On alert. It's the exist with performance. Our concerns right now exist with performance.
And are they invested the way that we expected them to be? It's just that their performance, I look back on page 12 and I see that their performance is below the benchmark, but it has been for some time. So I'm just wondering, has something changed, or did it just last long enough that finally we're ready to go put them on alert?
The thing that concerns me the most is when I see their relative ranks in the 90s. We expect that to resolve itself very quickly, but given that this is a public board and that we have policies and that we do have concerns with the performance, we think that it's prudent to make that move. This is by no means terminal.
Sure.
It is by no means terminal, but when we see performance like this, we think it's good to err on the side of caution. To answer your question, are they building the portfolio exactly the way? Yes, very much so.
Okay.
The portfolio is built of very large, very stable. They're not the fastest growing companies in the world, but these are excellent businesses with worldwide growth and worldwide exposure. That international revenue sources, investors are saying, we don't want anybody who sells to China, we don't want anybody who sells to Europe, we don't want anybody who sells outside of the United States because they're just not growing quickly enough for us. We think that's short-sighted, and we think that over the long term, that this portfolio will provide not only great returns, but even better risk-adjusted returns.
So do we need to take some action?
We had discussed before having an item on.
Yeah, that's right.
That would allow us to take action, and that we would just have that on each time. Was that our final outcome, that we would put that on as, because in some of our portfolios, like with the ERS, basically the investment consultant just puts them on alert and lets us know and notifies us we're putting them on alert or on notice, gives us the information. We don't actually take action on the ERS board, and what we, I think, had concluded is that we could go either way.
What we talked about last month, because the issue came up as to whether or not we needed to take official action in order to, like in this case, put somebody on alert. We did some research. We did visit with our retirement system folks, and I think caught the pension. Discussed with their consultants whether or not they needed formal action. And what we came back away from on those discussions was that the board itself relies on the consultant to go ahead and recommend and place a manager on alert or change the status. But Diana had mentioned she would like the board to have the capability to, if the board saw something that they wanted to take action, that they could come back to Doug at the next meeting and say, we have concerns about this manager, we'd like to place them on alert. But as of our last discussion, Doug can recommend and then just go ahead and place somebody on alert as long as...
So basically,
no
you're just notifying us that
board.
that's your intent, is to have them, and so our next report, we would see that you have them on alert or on notice. Okay. Is that... Okay. Great. All right. Thank you, Doug.
Thank you very much.
Yes, sir.
Yes. Page which?
6, the market environment index comparison.
Yes.
There's quite a variety of color coding in there.
Yes, I'll explain that.
We were just discussing our vision problems up there earlier. And I thought I'd kind of get a clarification of that
Certainly.
while it's still in my mind about what are we really measuring with the color scheme?
With the colors here, it's fairly simple. We like to color code it. When you look at there are 3 tables, right? Domestic equity, fixed income, and international.
Right.
The color coding tells you within that table, within each observation period, what was the highest performer in green and what was the poorest performer in red. Okay. So if we go over, just say, let's go to domestic equity last 10 years, you can see that the top performer was the MLP and that the poorest performer was the S&P 500. Okay. Now that's an extreme example, but it's pretty similar. Yeah. So it goes from dark green to light green to yellow to orange to red.
Okay, I got you.
It's a heat map. It does it actually automatically. And we think that it's a nice visual way to understand what's performing best. Thank you. I missed that. I'm sorry.
Thank you.
All right. Thank you, Doug.
Thank you.
I think we've already had action then to accept both reports. So I believe next item that we have is the agreement with Nyhart for our annual actuarial reports and services. Are there any questions on those items?
Move approval.
Approval. Yeah.
All right, I have a motion and a second. All in favor?
Aye.
Aye. Next item that we have then is the approval of the agreement with Bank of New York Mellon Trust for custody services, retroactive to July 11, 2013. Make a motion?
So moved.
Second.
All in favor? Aye.
All right.
The next item we had on here is to elect a vice chairman. I mean, basically, we had a meeting, I don't know, it was a couple of months ago, we had a meeting where I thought I was going to be gone and we would need to have a meeting anyway. And we thought, we had talked with Francis and Charlotte, and they had said that, technically, if I wasn't here, you could still probably take action and elect a vice chairman, but this way we'll just have it set, and that way we can make sure that the meeting can proceed. And I would like to nominate that Laura serve as vice chairman. Are you good with that?
I accept the nomination, although I just want to be on the record as saying that since Diana's not here, maybe we should consider whether or not she gets it. So.
That's supposed to be the automatic, right?
Just kidding. That's right. That's just kidding. What are you laughing about? You can be next. That's right.
Are you okay with that?
I'm great with that.
Great. Okay. All in favor?
Aye.
Very good. Next item that we have then is acceptance of the interim financial reports, and Michael Bingman is here from our Accounting Services Division to just give us some highlights on the financial reports.
Yes, I'd like to point out a few highlights regarding the preliminary June 2013 financial statements. If you turn to page 3 of the management discussion and analysis, under the changes in net assets reconciliation, we currently show ending net assets of $25.2 million. This is an increase of $6 million over the prior year, when net assets were $19.2 million. Overall, the financial position of the trust has improved during the year. For the fiscal year, the trust has gained $6 million. Of this, $1.1 million is generated from the indemnity plan, $1.6 million in investment income from the $26.8 million in investments we hold at this time, as well as $3.3 million is a result of overfunding from contributions from the city. If you turn to page 6, to the statement of changes in net assets, also the income statement, we show additions are reported at $30.5 million versus the previous year when they're $30.3 million. This increase is mainly attributed to the market value appreciation. Most of this appreciation is a result of the domestic stock fund performance. Benefits are reported at $24.4 million, and they have decreased $1.6 million, or 6.2% from the prior year. This is primarily a result of decreases in the indemnity plan expenses.
Michael, which report are you on? Are you on May 31st or the June?
This is the June.
June, I'm sorry.
Preliminary. Okay. If you turn to page 10 of the notes of the financial statements, our combined asset allocation to equities with international and domestic combined to 70.3%, with the remaining 29.7% in fixed income. During May, we had an additional allocation of $1.75 million was made to the investment portfolio, as $950,000 was contributed to the J.P. Morgan Bond Fund, $200,000 was contributed to the Thornburg International Fund, and $600,000 was added to the domestic stock funds, Dreyfus, Delafield, and Stevens. And this amount came from what we have invested in money market account. And the current investment in this at June 30 for money market would be $4.7 million. Are there any questions I can answer about the June preliminary statements?
Are there any questions? All right, thank you, Michael.
Thank you.
So I take a motion to accept the reports for May 31st and for June 30th. All in favor? Aye. All right, next item is ratifying the claims listing. Any questions? Take a motion on ratifying the claims listings.
Move it.
All in favor?
Aye.
Are there any reports from staff or any comments from the trustees? Seeing none, then we are adjourned.